and welcome to Gürkan Çakır's YouTube channel. Today we are going to talk about corporate tax in Turkey. Turkey has a competitive corporate tax rate compared to OECD member countries. Normally, corporate income tax is applied at 20% rate on corporate earnings. That being said, the rate for corporate tax has been temporarily increased to 22% for 3 consecutive years, including 2018, 2019, and 2020. Entities that are subject to corporate tax are joint stock companies, limited liability companies, other type of companies with share capital and similar foreign companies, cooperative companies, branch offices of foreign entities, public enterprises, enterprises owned by foundations and associations and joint ventures. Taxable income and earnings of corporate taxpayers are determined based on where the principal place of business is located. Full taxpayer status. Where its registered head office or actual business center is in Turkey, the corporate taxpayer is qualified as resident and subject to taxation on its global income. Limited taxpayer status. If neither registered head office nor actual business center is located in Turkey, the corporate taxpayer is qualified as non-resident and liable for corporate tax merely on the income generated in Turkey. Net business income is computed by way of deducting the expenses associated with the operation of business from the gross revenue generated by the business. In general, all the ordinary and necessary expenses paid or incurred for the generation and maintenance of revenue may be deducted. In terms of branch offices of foreign entities, expenses incurred by head offices can be deducted from the branch office's revenue, provided that such expenses are directly associated with the business activities of the branch office in Turkey. Participation exemption can simply be defined as the exemption of shareholders from taxation on dividends. According to Turkish law, dividends received by a company from its participation are fully exempt from corporate tax, provided that both entities are resident in Turkey. On the other hand, dividends paid out by participations outside Turkey are exempt from taxation as long as required conditions are met. Capital gains derived by resident and non-resident companies, including branch offices of foreign companies, are generally taxable as an ordinary income. Nevertheless, 75% of the capital gains resulted from the disposal of shares in domestic participations or from the sale of real estate are exempt from the corporate tax as long as the required conditions are met. When dividends are distributed to shareholders, companies are required to make a withholding at a rate of 15% from the dividends. However, dividends distributed to Turkey-based companies are not subject to withholding tax. A withholding tax is levied on the profits generated by branch offices of foreign companies upon transfer of such profits to company headquarters. The withholding tax is imposed on the distributable branch profits following the deduction of corporate tax. Annual tax returns must be filed at the related tax office within the 4th month following the end of respective accounting year. In case the total amount of quarterly payments exceeds the annual tax, the excessive amount can be offset against other tax liabilities or refunded upon request within 1 year in the absence of such liabilities.